if I think of my own personal trading system, because I'm running a fully automated system, I spend very little time doing it. Because I'm just using price data, I have automatic filters in place to catch bad prices. I spend about maybe 5 minutes per month per market. So, if I had 1,000 markets, then it would become a full-time job, and it would be quite a boring full-time job as well. I wouldn't be interested in doing that, but I could easily trade 100 futures markets, or there's probably about 150 really liquid futures markets out there in the world. And if I had enough money, I'd quite happily trade all of them, because even if the last market I had only adds a few basis points, is that worth 5 minutes of my time a month? Yes, it is, and that's my own personal trade-off. So,
before we find out who's on today's show, I want to mention that today's podcast is brought to you by Eurex. And in today's conversation, I actually learn about a brand new contract from my guest that Eurex have just launched, which my guest finds to be very useful for many investors, and which you can find out much more about by visiting the Eurex website. Today I'm talking to Robert Carver, who's both an author and a trader, and who spent a good chunk of his career at one of the biggest European systematic trading firms, namely AHL, before leaving in 2013 to write his newly released book.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
When these two things have something in common, yet they seem to be received very differently?
Yes, it is an interesting problem, because you're right. People have a strong preference for trading systems that generally make money every month, but every now and then lose a lot of money, which is the exact opposite to trend following. And I think I have a lot of emotional kind of bonding with these people. I feel like I really understand their pain, because when I look at the returns to my own system, inevitably, if I'm in a drawdown, I feel more unhappy than if it's doing well. And if I've had a day when I've lost money, even though I know from an intellectual perspective that this is just a random number drawn from some unknown distribution of returns that I hope has a positive mean. When I have a down day, I feel slightly less happy than if I have an up day. And if I had an up day every day for 6 months, then I'd be much happier. And so I have a lot of sympathy for that point of view. I think the sort of reason for the dichotomy between this emotional response and the emotional response to buying lottery tickets is to do with the size of the pain and the size of the payoff.
Right.
So. If you've invested all of your money into a trend following fund, you lose money for 2/3. Let's take an extreme example. Two out of every 3 days you're losing money.
Right.
You could be losing, maybe 0.5% of your net worth 2 out of 3 days.
Sure.
Whereas no one's probably going to buy that many lottery tickets. If I was to buy enough lottery tickets that it would represent 0.5% of my net worth, that would be quite a few lottery tickets. So the size of the loss that we get when we buy a lottery ticket is sufficiently small that it doesn't bother us. Now, if I've got this trend following system, it might be that if I have an exceptional month, I might make 20%.
Yeah.
So if you look at, say, September 2008, then the big CTAs were making that kind of, say, 20 or 40%, depending on their vol target.
Sure.
Now, 20% of my wealth is good. Don't get me wrong. If you take me a check with that tomorrow, I'd be happy.
Sure.
But it's also a lot less than I'd get if I won a lottery.
Yeah.
Which would be, depending on the payout, many times my wealth. So I think that's the reason the size of the gain and the size of the loss kind of skews our perception, makes one thing seem more attractive than the other.
Yeah, that makes perfect sense. Now let's talk about risk. And as Donald Rumsfeld said, the known unknowns and the unknown unknowns. What do we need to know about predictable and unpredictable risk, in your opinion?
So the main thing to bear in mind is that the risk has these two components, predictable and unpredictable. And the problem starts if you start to assume that there is no unpredictable risk, or at least you ignore it or you forget about it. And Nassim Taleb has spent the last 30 years writing books to make sure that we don't forget about it. But most of the time when we're trading, we have some model of how we think returns appear. Which can be usually pretty simple, and you'll usually say, okay, I think returns are going to have the following standard deviation and they're going to have the following correlation structure. And that implies that, you'll get returns coming day after day. You can have a certain chance of a loss of such magnitude and a certain chance of a gain of such a magnitude and so on. Now, that is fine, and you can't really run a trading system unless you do have some way of modeling what your returns are going to be. And you can make that more sophisticated and more realistic, so you can add in what the quantity guys would call higher moments. So you could add in skew and kurtosis, which means you instead of having a classic bell-shaped curve of returns, you have more funky returns, which are more realistic. For real asset markets.
Sure.
And you can also do things in the correlation space. So you can have things like co-skewness and all these, fancy things. Now, that's fine. The problem is the more fancy you make your risk model, the more calibration you need to do. And I think you mentally then assume that you must be capturing more of the expected risk, that the amount of unexpected risk left is smaller, which I think is what happened really in the financial crisis when we had these models of CDO prices, which were fairly sophisticated, certainly much more complicated than anything I could understand. But because they were sophisticated enough that people kind of assumed that they must be encapsulating the real world risk entirely, when of course they weren't. And there was this huge tranche of, pun intended, this huge tranche of risk out there which wasn't captured in the model. So my approach is to use the most simple risk model you can, which has no high moments, just standard deviation, just correlation, and then to mentally know that I am exposed to getting these things wrong.
Right.
And then what I do in my own trading system is I do relatively simple things like say, well, what if my model for correlations is completely wrong and actually all correlations are going to be either 1 or -1, whichever is worse for the position I have on at the moment. And on that basis, how much am I likely to lose? And then I kind of cap that exposure. And if my exposure goes beyond that, then I will actually automatically cut my positions. So, generally speaking, is hopefully you're understanding. I like things that are simple that I can understand, but also are robust.
Yeah.
And the way that I model and handle risk is exactly that way. So I do think if you've got a simple risk model, then you're never going to forget that it is a simple risk model, and you're never going to put too much confidence into the assumptions that it's making.
Sure. I have a few more questions relating to the book, and then I'm going to try and sort of seamlessly transition into some of my usual questions. So we'll see how that goes. But you touched very early on in our conversation, you touched upon the importance of the, and I can't remember the word you used, but it's essentially the management of your position. So it's partly the position sizing, but it's also how that position size stays, whether it's constant or whether it's changing along with the trade. Talk to me about why this framework is so important, because you were actually saying that if you get this part right, then the actual entry point is not so important. And for me at least, I would say that I think a lot of these systematic trading strategies, to a large extent, certainly if they're longer term trend following strategies, they tend to get into the same trades at the same time, give a plus minus a few days or whatever. But what sets one manager apart from the other is really, one, to your point, how they manage the risk along the trend, and the other thing is, of course, the exit. But let's take one at a time. Let's talk about sort of the sizing and the management of the position, because I think, again, this is something a lot of people may not see as important as you rightly put it.
So I think the problem is that people wrap up a number of different things together at the same time. So if you read a lot of trading systems that are out there, they often say, for example, you should never bet more than a certain percentage of your capital on a particular trade. And they then say, you should always, then you should own, never buy more than a certain number of futures contracts, assuming you have a certain amount of money.
Right.
And this is kind of confounding different things that should be separated. So let's take stop losses, because it's something that most people understand. Sure. So the kind of big question is, how should you set your stop loss? So if you actually follow the logic of the way that these systems are written, your stop loss will be different depending on how much money you have. Because if you're a small trader, you'll only be able to afford a very tight stop. If you've got more money, then 2 or 3% of your capital will be a much larger amount of money, and you can have a bigger stop. But the market doesn't actually know how much money you have and doesn't care. The price is going to move around the way it moves around, and in practice, what that will mean is that the smaller trader will get stopped out earlier, and the bigger trader will get stopped out later. And what that means then is that the smaller trader will tend to trade more frequently than the bigger trader. But the point I make in my book is that the amount of volatility in the market and the correct holding period in the market are absolutely nothing to do with how much capital you have. So these two guys should actually be trading the market in exactly the same way. And what that means in practice is you should calculate your stop loss based on how volatile the market is. So if the market is more volatile, then you need a wider stop. And secondly, on how long you want to hold that position for, because the wider your stop is, the longer you'll spend in that position. If the market is expensive to trade, then that's you'll probably want to have a wider stop than if it's cheap to trade and you can afford to hold positions for less time, in which case you can have a tighter stop. The point is that at no time in that calculation are you considering how much money you have. And then the next step then is to say, well, how big should my positions be? And it's at this point you then bring in, how much capital you've actually got, and how much risk you want to take on that capital. And then how much risk you should take on that capital is actually, it's not a simple question. There's actually about, I think I list about 8 different things you should consider when deciding, how much risk you should have in your capital. It's not just what your appetite for risk is, it's also how profitable you expect your system to be.
Sure.
It depends on what kind of system you're running. So a divergent system can be run at a higher risk than a convergent system, for example, because of the properties of the skew of the returns.
Sure.
So the point about the way I like to do things is very much about kind of taking separately what the components of the trading system should be, and then individually saying, well, what should we consider when making this decision, and then kind of moving on to the next step and saying, well, now we know how big our stop loss is. how should we then decide how big our position should be? So you've got to separate these things out and calculate them correctly. And that's something that's usually done in institutional setups pretty well, although maybe not in the same way or as explicitly. But if you're talking about retail traders, then very few of them will be using systems that have been set up in this way.
Sure. And in your experience, do you look at trades on a trade by trade basis, meaning that you have specific stop losses for each trade, or do you combine? Because you also talk about combining, signals together, and in order to get different, strengths of a signal. And so in some cases, obviously the other way of doing it is to say, well, actually we can either manage to risk by having a stop that takes us out at a particular point, but we could also manage the risk of having certain different entry points and exit points that essentially changes the signal, from long to short or short to long, and that's going to be how we get out of a trade. Do you have an opinion or a favorite of those two kind of ways of doing it?
So in my own system, I use the latter. So right. I call this. I like to call this continuous trading system. So you never have a discrete position. And if anyone ever says to me, what's your target stop loss on this trade? I get confused because I don't really know how to answer that question. Because the concept of a trade doesn't really exist. I just have a target position, which is implied from the forecasts I have for the price.
Sure.
And then if the target position changes, then I trade. And that at some point will take me from being long to being flat to being short, and then the implicit trade is closed. But that's not how I think at all. But I do discuss under the heading of the semi-automatic trader the alternative approach, which is what I would call the discrete position management, where essentially you have discrete trades and you kind of put them on, and then you don't take them off until you've hit the stop loss.
Right.
And this approach is better in circumstances where you don't have systematic trading rules, because by saying to the trader, right, once you put a trade on, it's not coming off unless you hit the stop loss, you're kind of binding them into that contract, and thereby forcing them to manage the risk and the profitability of a position in a way that's correct. If you said to them, well, you can take the trade off when you feel like it, then there's a risk that they'll do the wrong thing and trade in a way that's essentially going to break the kind of very carefully set up systematic framework that they've put themselves into.
Sure.
The other circumstances in which that makes more sense are, for example, if you're trading a system where you're mostly buying options, because you're probably going to just want to buy the option. And if you're going to buy out of the money options, then you pay your premium, and that's your maximum loss. So you don't really have a stop loss exactly, but you do have a discrete position where you bought an option, you hope it pays off, you've got a maximum loss. You don't need to worry about trading out of it. And the other reason why discrete positions work better, if you've got a non-systematic way of looking at trades, is it's just easier. If you've got to look at 100 positions every day and evaluate whether you should be in or out of them manually, by looking at charts or fundamental data or whatever it is you're doing, then that's obviously quite a lot of work, and it's much easier if you've got this very simple binary concept, whether you're in the trade or you're out of the trade.
Sure. You mentioned earlier on that a lot of professional managers in this space, they would often have a volatility target of their portfolio, say 15% or could be 20%, doesn't really matter, and they will target that on a kind of a daily basis, adjusting their portfolio accordingly. But I just wonder, isn't that like driving 100 miles an hour, regardless of whether you're on a motorway or in the mountains or in a city, so to speak, always having the same target of volatility of your portfolio? Wouldn't it be better if you could kind of adjust the target depending on the conditions, or if we're back to the racing analogy, whether you're driving in on a track or whether you're driving in a city, so to speak?
So I must have explained myself badly because that's not what most of these managers do at all.
Okay.
They do the target. Let's say that the target is 50 miles an hour, to keep with your analogy. That's a target they expect to achieve on average over a period of potentially years.
Okay.
They wouldn't expect to achieve it every day, or perhaps even assuming they're trading reasonably slowly, or even every month, and they might not even achieve it over any given year. The speed or the amount of risk you actually run is going to be driven by how much confidence you have in your forecast. So if your forecasts aren't very strong, then you perhaps just drive at 10 miles an hour.
Sure.
But on the other hand, if all the lights are flashing green and saying this is a really strong forecast and this market's going to the moon or to the ground, depending on which side you're on, then you drive at 100 miles an hour. You would normally have a speed limit in place.
Right.
So in my own system, my speed limit is 100 miles an hour, in the sense that I never have an expected known risk of more than twice my long run average target. I could go down potentially to 10 or 15%.
Okay.
And that's on the whole portfolio,
Sure.
Which obviously is made up of a number of different instruments. And on any given instrument, you may well have almost no risk or no risk at all.
Sure.
If there's literally no information out there telling you what your position should be.
Sure. Absolutely.
Now there are managers in different parts of the quantitative space who do have fixed risk targets. So it's more common in the equity long short space, for example.
Right.
So those guys generally are always driving at 50 miles an hour.
Okay.
And the problem with that is if you get into a situation where potential returns are compressed. So the classic case would be going into 2007. You cast your minds back. There's a situation in which a lot of quantitative equity long short managers all had essentially the same positions on.
Yeah.
And the amount of juice in those positions was seriously reduced. And, they were making just a few basis points and quite high leverage. And then there was a couple of bad days in August 2007 when, everything went against them at the same time. And that is the danger of running a fixed risk target.
Now let's try and make that transition a little bit and jump into something that I would normally ask my guests about. Let's start with organization, and I just want to ask you this. I mean, you've obviously spent a lot of time doing research, and you worked in teams, at large institutions. If you today were charged with the challenge of putting together a research team for a systematic fund manager, what would that look like? And do you need 50 PhDs or 2 PhDs? How does that all go together?
So there are three considerations, I would say. The first is the size of the team.
Okay.
The second is as you've touched on, the kind of educational attainment or general level of intelligence, if you like, of the team.
Sure.
And the third is the diversity of opinions and backgrounds. So team size, I do have to say that I think that the large numbers of researchers employed by many institutions are unnecessary and indeed could be potentially damaging.
Okay.
So generally speaking, if you were designing a systematic trading system and not one that's going to need to be adapted regularly, as we've already discussed, it's like building a building. You hire a bunch of people to design the system, and then really once the building is up, you're just going to need a few building maintenance guys to make sure the lift is working, and similarly, you're probably not going to need. Once the system is designed and working, you're probably not going to need 50 people.
Sure.
Depending on the size of the fund and the complexity of what you're doing. If we're talking about, say, a CTA with, say, high $100 million FOM, then I would say a team of kind of half a dozen people is probably sufficient.
Sure.
Second is on intellect and educational attainment. So So I should state up front first, I have no PhD, and although I try not to let it influence my thinking, it may well be that I have an unconscious bias against people with PhDs.
Okay.
But what I will say is I have worked with some incredibly smart people.
Yeah.
People who are, many, many times smarter than I am. I think it's fair to say that if we've got 6 people, if we have 6 kind of super genius people in a team, then it's probably going to be quite dysfunctional for a number of reasons. So I think you do want smart people, but I don't think there's necessarily a positive correlation between how smart people are or how many degrees they've got. Beyond a certain point, I mean, you don't want some guy who's maybe very bright but doesn't have the right kind of mathematical background to cope with the sort of stuff we have to deal with. But that doesn't mean that everyone has to have a PhD in statistics or economics or physics or whatever. I'd like, I think, sort of people who are clever, but not necessarily a team of geniuses, because geniuses are quite hard to manage. And, if everyone on the team is a genius, then, who's going to do the dirty work?
I seem to remember a firm back in 1998 that was probably a team of geniuses and a few Nobel Prize winners as well.
I can't remember the name of the firm, but it was long-term something management.
Right.
Yeah.
Yeah.
So that's an interesting example, perhaps.
Sure.
And finally, in terms of the kind of backgrounds of the people, so. If I look at AHL, for example,
sure.
If you go back to the early 90s, I think pretty much everyone that I hired had a degree in physics from Oxford or Cambridge.
Right, okay.
So you had a lot of people who really thought in exactly the same way. There are probably a lot of hedge funds out there staffed exclusively with people who've been to the University of Chicago, with the kind of Eugene Farmer doctrine hammered into their heads. The problem with having a lot of people who all think in exactly the same way is, you've got the old story is if you've got 6 people in the room and 6 of them got the same opinion, then 5 of them are a waste of space.
Right.
I do think you need a diversity of backgrounds, and one of the interesting things about the business of systematic trading is it does bring together a lot of different skills, and you need people who know about IT and computing. You need people who know about economics. You need people who know about how financial markets actually work and who ideally have had some trading experience. You need people who have got that kind of statistical ability. You do need people with a range of backgrounds, and it's unusual to find people who do combine those. And I've already said I'm a rare exception, but that just means in practice that I'm sort of not too bad at a number of things rather than being brilliant at any of them.
Sure.
I think in this business, it's better to have a team of people from those different backgrounds who are going to think differently and not just follow the same train of thought and be exactly the same.
Sure.
There's been a lot written about things like herding behavior, and you don't want herding behavior in your team. You don't want everyone coalescing around the same opinion.
No. I mean, I agree with what you say, but it is interesting that there is still a preference, I think, from many institutional investors to go with the firms with the larger teams, although there is nothing to suggest in the performance data that, 50 PhDs is better than one, so to speak. But obviously there are some other things that you do when you have large teams. You usually also have to accommodate managing and executing large amount of money, and that takes research as well. So for sure. Now, I want to ask you a little bit about track records. How investors should read them, because not everyone has a 20, 30 or 40 year track record. And even if you have a 30 or 40 year track record, the system will have changed over time. People make changes. That's why they have research teams. And on one side, investors want you to be innovative, but on the other hand, if you say you make changes, they don't necessarily like that either. So how do we put all of that together, and how should investors deal with historical track records?
So the biggest problem we have when looking at historical track records is this issue of statistical uncertainty. So it's exactly the same problem that we have as researchers when looking at a backtest.
Right.
We don't know whether this apparently really good backtest or really bad backtest is just just bad luck or good luck. It's the same problem that investors have. And one of the things I like to do is actually plot the evolution of the estimates of portfolio means and correlations over time. And even with 10, 20, 30 years of data, you're never really in a situation where you have a significant difference between two portfolios, which actually are quite, in the long run, would be quite different. Then that really hammers home to me the difficulty of this job. So I would look at it. I personally, if I was running a fund of funds business,
Sure.
Then I would look at track records, but I probably wouldn't put a huge amount of effort into analysing them to death. I mean, I do think if you're in a fund of funds business and you employ a smart researcher, the first thing the smart researcher will do is take the 20 years of 12-month returns and do all kinds of amazing statistical analysis with them, which can be. I think you can go over the top with these things. I mean, I think I remember seeing once a presentation by someone in a fund of funds business who'd analysed a track record of 3 managers over 10 years, and there were actually more slides than data points, which is probably going a bit far.
Sure.
But the basic things to do, I mean, look at the track record, and it should be similar to the track record of people who are supposedly doing the same thing. So if the guy's trend following and he lost money last year, then you should kind of have a big question mark.
Right.
That might mean that he's really bad, or it might mean that he's not trend following at all and he's doing something else.
Sure.
If the guy did really well between 2011 and 2013 when trend following did badly, then again you should be saying, well, is that due to exceptional skill, or is that because he's doing something quite different from all the other trend followers, and maybe he's actually exposed to some kind of risk.
Yeah.
I would, if someone's performance was like really, really bad or really, really good, so well outside the distribution of what I'd expect, then I'd probably dismiss them, both for being really good and really bad. So if someone comes to me and they've got a 20-year track record and they're doing trend following of futures with an average holding period of a month and their Sharpe ratio is 3, I'd say it might be that you're a genius, but to be honest, it's more likely you're the next Bernie Madoff. So
Right.
I'm really sorry, but we're not going to invest in you.
Sure.
And then I would spend much more of my, I've hired this smart research guy in the fund business. I'd then send him to talk to the smart researchers in that business and ask them questions and make sure that they, not ask them to give anything away, but make sure that they could explain, what they were doing and what risks they felt they were exposed to. And it would be much more of a qualitative judgment for me rather than just looking purely at the track record.
Sure. So I remember from an ebook you helped me put together recently, you have something called Explain Your Strategy in Terms My Grandmother Would Understand It.
Yes, exactly.
Now, speaking about performance a little while longer, in the systematic trading world, obviously we have the very short-term strategies, we have the longer-term strategies, and we have all sorts of other strategies that can be systematized. Often people will, I hear the point about, but there's too many people doing trend following, there's too many people doing short term or high frequency, that's going to be dead because this, that, and the other. I mean, did you have an opinion about these concerns that people might have with these systematized strategies?
The main considerations are the kind of size of the systematic traders in that business versus everybody else, the style of how they're trading, and whether the conditions are likely to change in the future. So let's take high frequency trading. So high frequency trading is basically, as far as I can tell, 100% systematized.
Right.
There is no human being who can click with some exceptions. I mean, there's some people who are being prosecuted for spoofing.
Right.
Markets who apparently have been doing it manually, which is quite interesting, and have actually been able to take money off the high frequency traders. Unfortunately, at the cost of doing something that is alleged to be illegal. But generally speaking, the high frequency end is 100% computers, because humans just can't compete.
Sure.
The things that humans are good at are completely irrelevant when the only thing that matters is the latency and the speed at which you're trading. These things aren't doing highly sophisticated calculations. They can't be, because their main job is to turn around as fast as possible and update the orders they have in the market as new information comes in. Will that go away? Well, no, I think that business will remain 100% systematized. But as to who will make money in that business, I mean, at the moment, if you believe the media, then basically it's the high frequency shops that are making the money, and the people who are going into that market to execute, who are paying effectively a tax.
Right.
And they're obviously, the third part of my earlier statement was, will that market change? Well, you have things like, obviously, a lot of fuss in the US about this. Hillary Clinton's highlighted it as a problem. You've got IEX, which is the exchange set up deliberately to frustrate HFT. The market will probably change, but my opinion is that there will always be high frequency firms out there. They will have to adapt.
Sure.
And they probably will adapt. The size of the profits they make may go down a bit, may go up a bit, but I believe that will always be a business which is profitable. That doesn't mean to say that any individual firm doing it will always be profitable, or that any strategy that's working now will still work in a year's time. That's almost certainly not true. Now, if we go to the other end of the scale, actually, let's go somewhere in the middle of the scale. Let's think about kind of medium speed, relative value trading.
Right.
So let's suppose that you're doing long short equity trading.
Sure.
So you've got a bunch of equity factors, and let's just make it simple and assume you've just got one factor, which is book value. Obviously, the world is much more complicated than that, but that doesn't change the argument. So you've got a lot of firms that are cheap. They've got high book value, and a lot of firms are expensive, got low book value. So you do a long short strategy on those, and you do that in a systematic way. Now, if only 5% of the people in the market are using that strategy, then that's great. You'll continue making money. But if 50 or 75 or 90% of the people in that market are using that strategy, then pretty soon the opportunities are going to disappear. The prices of the firms that are cheap will be bid up.
Sure. Prices
of the firms that are expensive will be pushed down until they're in the extreme situation. They'll all be the same price. So in those areas, the profitability of those systems, and it's not even systematic trading per se. It's more the profitability of that kind of investment factor.
Right.
Is cyclical. So there are times when you can make a lot of money with that kind of trading, and it's normally actually after a market crash. So it depends on the kind of crash. The dot-com tech crash back in 2000. After that, actually, value stocks weren't that cheap because they hadn't gone up that much in the tech boom. It had been all the the growth stocks that had gone up.
True.
Whereas after in the more recent crash, in 2009, you could pick up a lot of value stocks really cheaply because they were the businesses, things like house builders,
sure,
that had really been hammered, and therefore value investing would have done extremely well in the 2 or 3 years out of that period.
Yeah.
So that's a cyclical business. So it won't ever go away because it's just that it might go away over the next few years, but then something will happen and it will come back again. And you can either take the view that you'll just always be in that strategy over a very long period of time, or you can try and be a little bit smarter and say, well, I'll put more money in when there's more value. A bit like driving faster than 50 miles an hour.
Right.
When the road is clear. We go
Sure.
back to the earlier analogy.
Sure.
Now let's take something like a slower strategy like trend following. So the thing about trend following is, unlike a relative value strategy, is that if more people follow it, it actually becomes self-reinforcing.
Sure.
So if when markets go up, there are trend followers in the market who will buy it, then the market will continue to go up. So from that point of view, having more people in the market may actually improve your returns rather than harming them. The issue then comes around execution, because if you have a lot of people trading one market who are all running the same model, and then the price moves against you, they're all going to want to rush for the exits at the same time.
Yeah.
There are probably futures markets out there which have quite high percentages of people in them who are running CTA type strategies. We at AHL, we always made sure we were less than a certain percentage of the open interest.
Sure. Yeah.
Sort of figure I can disclose, and it's probably changed anyway. But let's just say it was 10%.
Sure.
It wasn't, but let's say it was.
Yeah.
That's fine. But if you say you're less than 10%, but if you then have 10 large CTAs, all of whom are saying, well, we'll only be up to 10% of the open interest, all of a sudden you've got a market that is 100% CTA.
Sure.
And they're all going to rush for the exits on a correction in exactly the same way. So that the underlying returns of a trend following CTA type strategy, because it's pretty slow, because it's based on human behaviour that I think at least shouldn't change.
Yeah.
Will probably still be around for a long time to come, but there may well be periods when there are too many people in that strategy. It gets crowded, and that will mean that there'll be these unexpected liquidity problems at times. But in the long run, it should probably be okay.
Sure, which is kind of why I certainly also feel that in some ways I think the exit, however you do it, but I think the exit is another important factor in these strategies, at least in order to avoid being caught up in when maybe a large part of the same strategies is going to get out at the same time. Now, I want to ask you a question that I never asked to anyone really, because they may not be as in the details as you clearly are. I just want to, when you look at all of these things, is there any one statistics that you really like? You think this is just a great one to, some people talk about Sharpe, some people talk about Sortino ratio, Omega ratio, all sorts of different things. I don't know. Is there something when you do your analysis that you feel, this is important, and I'm gonna put a lot of emphasis on that?
I generally look mostly at Sharpe ratio.
Okay.
And that's because it's relatively simple to calculate.
Sure.
And because I've generally looked at Sharpe ratio for, the best part of 10 years, I have a very strong intuition as to what is a good Sharpe ratio, what is a bad Sharpe ratio. Now, the disadvantage of Sharpe ratio is obviously it assumes a symmetric returns. And for that reason, the other thing I will look at is skew.
Okay.
So positive skew means that, generally speaking, you have more losing days than winning days, but your winning days are bigger. So that's very much like a trend following strategy.
Yeah.
A negative skew means that you're making money more days than not, but when you have a loss, it's a big loss. And that would be something like a relative value strategy, or perhaps a carry strategy.
Sure.
So the problem with skew is that, without getting into technicalities, but the higher up you go in the distribution, the more moments you calculate, the more unreliable the statistics are, and the more they can be distorted by just one or two data points. And one thing I'm very aware of is with a lot of negative skew strategies is that they may not have had their big down day in the back test.
Right.
Which economists call the peso problem. Going back to the Mexican peso crisis in the 1980s. So I'm very suspicious of a strategy that has a high Sharpe, makes money more days than doesn't make money, but then it has never had a big loss. Because I'm always thinking, well, this thing must be exposed to a risk, which is out there. And if I was in this hypothetical situation where I was working for a fund of funds organization, I would go to the managers and say, right, what keeps you awake at night? What's the big risk you're exposed to? What can go wrong? And if the guys just kind of shrug their shoulders and say, "Oh, nothing, it's wonderful," then I won't invest in them because they clearly if they can articulate and say, "Well, yes, this looks amazing and the back test looks amazing, but we know for a fact that we are exposed to this particular risk, but we've quantified it, and we think that we might have a 20% down year if it happens." And then I might actually be happy enough to invest in that strategy.
I'm going to give you a challenge, Rob, because I have so many more questions and I know we can't get to all of them. So the whole next section, which is where I wanted to talk about your own trading strategy, I'm going to formulate it, or at least I'm going to try to into one question.
Okay.
And that is, taking everything you've done, the research, your writing, and all of that, how have you ended up from a sort of 30,000 feet point of view, and maybe a little bit lower than that, how have you ended up with your own trading system? What does it look like today?
Okay, so I trade about 40 futures markets. Mm-hmm. They're spread over all the main asset classes. And as I said earlier, you have to be diversified in this game. Diversification really is the only free lunch in finance. So, and I've got a good spread of assets and geographies.
Sure.
If I had more capital, I'd have more markets.
Sure.
It's as simple as that.
But how many? But just on that point, but how many more? Because I think that's a big discussion as well. Because I find that certainly in some of the studies that I've seen and been part of, there is a number of where you don't really get any more diversification benefit. And so people who trade 200 markets, they do it because they need capacity. They don't do it because they need more diversification. But I don't know what that number is, whether it's 60 markets or whether it's 70 or 80. I don't know. Where would you like to go in terms of number of markets?
Well, theoretically, there is always a benefit to adding another market,
Sure.
which isn't 100% correlated.
Sure.
Now, the question is, what is the cost of adding that market?
Yeah.
So if I go back to my institutional experience at AHL, one of the things I did while I was there was add a lot more markets to the system, mostly OTC interest rate swaps and credit derivatives. And, one day the COO called me into his office and said, you've added all these markets, what's the, is this really necessary? And I said, well, if you can tell me what the cost is of each of these markets, then I can say, whether I think it's worth it or not, because it might be that the last market we added was a tiny, tiny fraction of the portfolio and added only, 1 basis point to our performance. 1 basis point on, $10 billion is still, I can't work it out in my head. Sure. But if the cost of adding that market in terms of operational costs or back office costs or whatever, it exceeds that 1 basis point, then yes, I agree, it's been a bad trade. In the end, we discussed it and decided that I was right. But if I think of my own personal trading system, if I had a market, because I'm running a fully automated system, I spend very little time doing it. Because I'm just using price data, I have automatic filters in place to catch bad prices. I spend about maybe 5 minutes per month per market. So, if I had 1,000 markets, then it would become a full-time job, and I wouldn't it'd be quite a boring full-time job as well. I wouldn't be interested in doing that, but sure. I could easily trade, 100 futures markets there's probably about 150 really liquid futures markets out there in the world.
Okay.
And if I had enough money, I'd quite happily trade all of them, because even if the last market I add only adds a few basis points, is that worth 5 minutes of my time a month? Yes, it
sure.
is, and that's my own personal trade-off. So
sure. So you got 40 markets at the moment. Tell me about sort of the number of different strategies and models that you decided upon in your own, and what kind of style did you end up become? What kind of style trader did you end up becoming? So
everyone listening to this so far has probably concluded that I'm obsessed with trend following, and my system would be 100% trend following. So I'll now disappoint you and tell that my system is only 40% trend following. It's also I'm not just I'm doing a few different ways of doing that trend following, which are all fairly highly correlated with each other. But just adds a bit of variety.
Sure.
Then I have a chunk of a carry system.
Mm-hmm.
So that's going to be looking at the slope of the yield curve and looking at the roll down and the contango.
And is that both in yields and or commodities, or mainly in commodities where there seems to be?
It's across the board. So
Okay.
one thing I concluded is there's not really enough evidence to say that different systems work much better in different asset classes than others.
Mm-hmm.
And I mean, there are some exceptions. So it does seem, for example, that trend following relatively quickly doesn't seem to work as well in equity indices as in other markets.
Mm-hmm.
And that then finding follows through down into individual equities as well.
Mm-hmm.
Actually, Andreas Klonau has a nice piece on his blog about this quite recently.
Yeah, absolutely. I saw that.
But on the other hand, if I actually look and be really statistically rigorous and say, is there enough statistical evidence in the back test to say I should run a different system with S&P 500 futures as with US 10-year bonds? I don't see that. So I take the simple approach of running exactly the same system in every market, with the caveat that I do adjust for the expected trading cost of the market. And therefore, on a really cheap market like NASDAQ or S&P 500, I will be trading more quickly than on something like Australian interest rate futures, which is a relatively expensive market. I have a systematic short bias on the two volatility index markets I trade, which is the VIX and the European equivalent, the V2X. And that's because I believe that being short the implied versus realized vol premium is a kind of source of return, and ideally I'd have the systems you can build that capture that more efficiently. But in my current trading space, the simplest way of doing that is just to have this little short bias in those two markets.
How much of the overall risk would you allocate to that kind of strategy?
It's about between 5 and 10%. I can't remember exactly. It's not a lot, because that obviously is pretty. That's the real dark side when it comes to risk properties. These things have 4 times the skew of the equity markets they track, and if something like 2008 happened again, would be pretty dangerous. But because I'm also running a trend following and a carry system on this market, if things really went badly, I'd be out of the position. So it's not too much of a concern.
No. In trend following, at least, my experience is that there is a disproportionate part of the profits in long-term trend following that is being made from the long side of the trend of the trades. Have you looked at that? And if so, do you adjust for that fact?
I mean, again, it comes down to statistics. So part of the problem is, especially in the financial markets, so the bonds, the equities, the interest rate futures, there has been this massive long secular trend for the last 30 years, which you touched on earlier.
Sure.
Which means there isn't really that many times when the market's going down. So it's really hard to know if we had a less unbiased data set where there were roughly the same amount of bear and bull markets, then we could probably be able to make that decision a bit more easily. And you can try quite clever things like trying to adjust the history of the past to remove this secular trend, and then refitting your system, and you kind of get this result coming through. But again, I've become a lot more rigorous in my old age. So when I was younger, I used to, if I saw something that looked good in a back test, I'd immediately put it in. But now my bias is towards doing nothing and keeping things as simple as possible and the same across the board. And so I need really strong evidence to suggest that what you said was true to actually put that into my system. And there's definitely something there, but unfortunately, because we've got this bias, it's rare that you'll see a statistically significant difference between those two environments.
Sure. I have a little bit of a cheeky question. Hope you don't mind. You've been running your system for a while now. No PhD. How are you comparing to your old friends at AHL?
So I review my performance annually.
Okay.
So after the first year I was running was from April 2014 to April 2015. And looking at Sharp ratio, I think they had a Sharp ratio of 4, which just goes to show you what an incredible year it was for Trendfollowing. And I had a Sharp ratio of 2.8,
Okay.
which put me somewhere in the middle of the pack in terms of the CTA. So there were some other CTAs I was doing better than. This year I have done. I haven't looked at the numbers in a formal sense, but I know I've outperformed them.
Okay.
And I can do a little more analysis when I get around to it, but my intuition is that is because I do have this higher allocation to non-trend following strategies. So it's probably not a fair comparison from that point of view.
Sure.
I would expect over a long period of time that they would outperform me, mainly because they do have many more markets. And that is a key, a key difference between a small retail investor and a large investor. That is the main advantage a large investor has, definitely.
Sure. Let's jump to another topic, just touch upon that briefly, and that's drawdowns. We've spoken about it a little bit. I have a couple of questions. What's the best way of getting a gauge on a system's potential drawdown? Have you found any rule of thumb, or can it only be done through, hours of testing? How do you find out what to expect on the downside?
So one thing you can do is to completely forget about your real data and just run experiments with completely artificial data. And this has an advantage because if you have some real data, you just don't know whether you've been lucky or unlucky. So it might be that your drawdown was exceptionally small or exceptionally large, just through good luck or bad luck, and you don't know whether that's realistic to expect in the future. And that may lull you into a false sense of security, or may scare you, and you wouldn't think about trading the system because it's too dangerous.
Sure.
So what you can actually do is run a number of different account curves with random data, with some Sharp ratio, with some skew, whatever it is you want to do. And then you can then look at the measure the drawdowns in each of those simulations. And then what you can then do is actually look at the distribution of the drawdowns across those simulations. So that sounds kind of complicated, but let's if I give you a specific example. So let's say that you're running a system with a risk target of 20% a year, and you expect your Sharp ratio to be 0.5, which maybe is a little bit pessimistic, but even if your true Sharp ratio is more than that, is 1 or 1.5, it's not beyond the realms of possibility that over a 10-year period you might, maybe even if you look at the big CTAs over the last 10 years, that's probably roughly where their Sharp ratio is.
Sure, completely agree.
Now, if you look at you can then plot the distribution, and so for example, if you plot the distribution of the average drawdown, so on any given day in any of these random simulations, your average drawdown is about 10%. So most of the time you should have a drawdown of about 10%. And if you have a drawdown that's 10% sounds a lot, it's half your risk target. That's the kind of rule of thumb. But there are also realizations, 10-year periods, where your average drawdown is 50%.
Sure.
That's pretty rare, but it could happen. So you need to have that in the back of your mind. Now, people probably don't worry too much about average drawdown. They worry about worst drawdown. What's the kind of the worst possible case? So if you look at worst drawdowns over a 10-year period, then the average is around 40%. So it's twice your risk target.
Right.
That's another good rule of thumb, is that over a 10-year period, your worst drawdown will probably be about twice your risk target.
Okay.
So if you've been running a system for a few years and it goes down 40%, you probably shouldn't panic, because that's kind of roughly what you should expect. But again, if you look at the streams, then there are runs where you can have an 80% drawdown. Which
I think most people would start panicking by that. Exactly.
So that's not impossible, and to me that really it just reinforces the message that you really ought to be in a position where you can lose all the money you're trading.
Right.
Because it could happen.
Sure.
I mean, you hope it won't, but it could.
Okay.
While you'd be extremely unlucky if you've got a Sharp ratio of 0.5 or higher, you'd be extremely unlucky to be in that situation, but it could happen, and that should always be in the back of your mind.
Sure.
So those are nice rules of thumb, and that's easier and better than looking at a back test, which, as I said, may be biased and give you an unrealistic picture of what the drawdown really ought to be.
Sure. Now, being mindful of the time, I want to jump again to just another section and just ask you a quick question before we end up in the last part of this conversation. Now, you've clearly been part of many due diligence meetings, phone calls, investors wanting to ask questions about the strategy you were working inside, and so on and so forth. And sort of, if you take that hat on, what are the things you find that investors should be asking but they never do?
Well, one is the question I touched on earlier, which is what can go wrong?
Right.
What keeps you awake at night?
Yeah.
No one likes to hear bad news, I guess, which is why, and it also seems potentially, I suppose, like quite a rude question to walk into a room and say to somebody, right, when are you going to screw up? How's it going to happen? Tell me all about it. Really, that's a very important question to ask, particularly if you've got a strategy that's exposed to a really bad risk that hasn't happened yet. The other question, I think I could probably go back to the 3 points I made at the beginning about overtrading,
right,
overbetting,
sure,
and overfitting. Investors will look at the risk properties, and I think savvy investors understand have a feel for things like leverage, and will know that if you make 40% in 1 month, then potentially you've got a high risk and you might be overbetting there. They kind of understand that. What they don't necessarily understand so well is the overfitting. So and this obviously is hard for someone who's coming from a different background to you and I, and isn't familiar with it. But as you said earlier, explain to me in terms my grandmother would understand how you fit your models. What's the process you go through?
Sure. And
if the researchers describe a process that it seems to involve a lot of iterations, then immediately alarm bells should be going off in your heads.
Sure.
A better question is to say, tell me about this particular model. Because they may, if you ask them, how do you fit your models, they may just rattle off some corporate BS about, we follow this very rigorous process, blah, blah, blah.
Sure.
But if you say, well, how did you fit this model? Where did the idea come from? What did you look at? Then you're going to get more honest answer out of them, and you'll get a feel for whether there is some danger of overfitting going on there, and if so, how serious it is.
Sure.
And the same with overtrading. I think very few investors ask about trading costs. As I said, I think it really is something that most people in the industry don't pay enough attention to.
Sure. No, there's no doubt that transparency in these situations is very important, and as you mentioned in your book, that goes also for politics. Anyways, the last section, Rob, we're almost there. General and fun. And I'm just going to pick a couple of ones I think could be relevant for our conversation today, because we've clearly touched upon a lot of the technical stuff. You've written a book, but if you couldn't recommend that, which other book would you recommend for someone who wants to get into this business or want to learn to understand it better? Is there any book that you read that sort of stands out to you?
So my book wouldn't be the first book you'd read, I think, if you were interested in the systematic trading business. So there is a book I read myself about 15 years ago, before I knew what systematic trading was, and it's called The Predictors.
Mm-hmm.
There was, I don't know if you've heard of Doyne Farmer. He's in something called econophysics.
Okay.
And he was one of the inventors of chaos theory.
Mm-hmm.
And he in his youth, he did fun things like trying to build what we would now call wearable tech, a computer that would predict where a roulette wheel would land.
All right. Okay.
Land and try and make some money out of that. But the technology wasn't sufficiently advanced, and I believe there were some electric shocks. Anyway, he moved on and ended up founding a hedge fund, which was doing systematic trading, and this was in the early 90s. And it's a very well-written book. It's not technical. And I read this book and thought, this is what I want to do. Okay. And it gets across really the feel for, how you do this job and the things you have to worry about. And there's some great passages in there about the little anecdotes that really get across what overfitting is. I mean, the phrase is never used in the book, but you really get the feel for what it is and how you have to worry about execution costs. And at the time, I just thought this is a really interesting book, a really readable book, and I just find it fascinating. So.
Sure. And in your and I'm not entirely sure which career I would because you've kind of had a couple of different careers, you could say. So you can relate the question to what you want. But what would you say has been the biggest failure on your side, and what did you learn from it? And I use the word failure loosely here because I think you've done pretty well. So.
I've made a lot of mistakes. If I think about when I was working at AHL, there were a number of times when I did things that I would no longer do now. It's quite hard to pick out the biggest one because there have been so many. But there've been this I'm perhaps I've been lucky. I've never had a kind of single kind of blow up or disaster, if you like, that sort of really knocked me back. I've had a long series of small disasters, which have left me still standing and able to learn from them without being completely knocked down. So, I mean, arguably, you could say that when I left Barclays, where I was trading, that was a failure, arguably, because I failed at doing the job that I've been hired to do, in the sense that I felt it was not what I was any good at. Really from that, I learned that trading is not what I can't trade. Sure. Discretionary trading is not something I can do, and most people, a lot of people think they can do it. I don't think they can either. But I was fortunate enough to learn the lesson quite early on. So. Sure.
No, that's an important one. That's an important one for sure. Now, you told us an interesting fact about yourself, which I had no idea about your stellar sailing career.
Long time ago,
you say. But can you tell me a fun fact about yourself? Something that even people who know you, and let's maybe exclude your wife and children here, but people who may even know you don't know about you. Is there a different side to Rob Carver that we don't know about?
I have a real addiction to trashy television.
Okay. Can you recommend any?
Particularly, there's what I would call trashy business programs.
Okay.
There's a couple I mentioned that run in this country. One is The Apprentice, which I think is international now.
Sure.
I know there's a US version which had Mr. Trump.
Yeah, interesting, isn't it?
Yeah. But this program is absolutely appalling because it is completely unlike. It's completely. You would not run a business the way this program works. Sure. It encourages people to behave in ways that are incredibly bad, but great television. This I don't know why I enjoy watching it. I don't know whether it's Schadenfreude because I'm thinking, gosh, I'm so glad I'm not like these people. Right. I've never had to put myself through this or what. But it's compelling stuff.
Sure.
And then there's another program called Dragon's Den, in which which perhaps isn't so well known outside of the UK, where people have to pitch ideas to some venture capitalists.
Yeah.
And again, it's a complete, slightly more realistic than The Apprentice, but it is a bit of a farcical representation of how the real world of business works.
Sure.
Of course, the irony is if there was a highly realistic program about business, it would be incredibly dull and I wouldn't want to watch it either. So, I understand why these programs are made.
Exactly.
I hate them, and I hate myself for loving them so much. So there we go.
Yeah, Dragon's Den in the US, they call it the Shark Tank. So
okay,
that's what it is. It's already there. Now, you mentioned you have children, and I was curious to know if you could choose only one of your own skills to pass on to your children, what would that be, and why?
I mean, if I was to choose an attribute rather than a skill, it would be that I'm a very optimistic person.
Mm-hmm. Sure, that's allowed.
I always, think, and I also never ever look back and regret anything that's happened in the past.
Sure.
I think those two things for me at least go together. So that makes a life more fun and more tolerable. And I think that's probably of more use than saying, I wish my kids were, as good at maths as I am. Not that I'm that good at maths, but, or had...
Sailing, perhaps. Apparently that seems to be a good...
Perhaps. But yeah, that would be the attribute I'd like. That's what I'd like to pass on to them, if nothing else, definitely.
No, that's important, absolutely. Now, we're coming to an end, Rob. I have one particular question left. I asked earlier about what investors were missing out when they talk to people like yourself, what they should be asking. So I'm going to turn it always on myself at the very end and say, was there anything today that I missed? I want to make sure I give justice to you and your book. So is there anything you want to bring up at the end here that I failed to ask you today?
I'm just going to be really cheeky and just plug the book some more and say that if you go to www.systematictrading.org, then you can find out more about it. And there's also a link to my blog, a link to the publisher's page where you can buy it if you want to.
Sure. No, absolutely. And I was going to absolutely mention that, and I'll probably mention that a bit later. As we wrap up, I want to thank Eurex, the exchange, for sponsoring today's episode. And as many of you listeners today will know, Eurex is a great place to trade, especially if you're a systematic trader, because there's quite a lot of liquidity in most of their contracts.
And they've just launched a mini DAX future, which is a really, really interesting contract because the DAX is a bit large for retail traders at the moment. So that's a little plug for that.
Well, thanks very much for that, because I was not aware of that. I'm sure they'll be happy to hear us discuss that and promote that. From my side, I also want to mention to our listeners that it might be a good idea to go to your smartphones and activate the subscribe button, because I've noticed that some of these feeds on the podcast are no longer automatically updating the media player. So if you wouldn't mind, just pick up your smartphone and make sure you are subscribed to the podcast. And that really leaves me to thank you, Rob. This has been a great conversation on a Saturday morning, a true masterclass in systematic trading, which I really appreciate. And I also appreciate your willingness to share your insights and your views in this field. And the book, of course, is Systematic Trading, as Rob mentioned. And I suggest you grab a copy or two of that. And of course, the listeners can also find all the details of today's conversation in the show notes on toptradersunplugged.com. So, Rob, I hope we can connect at a later date and get an update on your great work. I really appreciate your time and what you've done. So thank you ever so much.
Thank you very much, Niels. It's been great fun.
Absolutely. Take care.
Bye-bye.
Bye.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.